Okay, Jason.
Okay, Peter, are we ready to go?
Um, yeah, let's go. I'm ready to go. Start your
Okay, so
engine.
so let's go through the formalities. On behalf of Zeifmans, I'm Jason Price. I'm a partner here, and I can't believe it's been 4 years since we did this. Uh, I had just or was in my 60th year, and in I think 2 months I'm going to be 65. Lots have transpired. I'd like to thank Peter for being a part of making COVID fun for everybody. I think everybody's learned, and as we've gone through COVID,
COVID's fun.
um, I think people have become dependent upon, and we receive requests on a pretty regular basis um, for Peter to deliver another economic briefing. For everybody's information, this webinar will be recorded and will be available on our website when we're finished. Any questions you we'll ask the questions as we go through. Um, for those that you don't know, Peter's an advisor to some of Canada's most successful family businesses. He's a PhD from Harvard and currently lives in Austin, Texas, where it's a little bit more. You can't. Is that better?
Yeah, we can hear you now.
Yeah, there's a big
I can hear
storm
you
here.
too.
Okay.
Okay, Peter, you're up.
Jason,
Okay.
just sorry, Peter, I'm just going to interrupt. Jason, I'm not sure what you said. We didn't hear you for about a minute there.
Oh, all I said was it's being recorded. Questions in the chat, and Peter's going to take us through what's going to happen in the next 2 or 3 months, which might be the next 2 or 3 weeks, given where we are geopolitically.
Okay, Jason. Thank you. And thanks to everyone who's on the line. First of all, I want to tell you a secret. The secret of economic forecasting, Jason. The secret is get today right before you start talking about the future. Okay. And the other thing about a forecast is make sure it's not a target. A target is what you want to see, and a forecast is what maybe you will see. Uh, and then biases. Beware of biases. We all have biases. Some people have pessimistic biases. Some people have optimistic biases, and some people have skin in the game and are biased because of that. So beware. Anyway, Jason, I'm going to get right to the bottom line here. I'm going to give you the punchline right at the start. This is what I think. I think we're in a new business cycle. I think we've got growth ahead of us, not a recession. Why did we get it wrong last year? I blame the inverted yield curve. Ever since the mid 1950s, the yield curve has been kind of the gold standard of making predictions. And this time around, I think it gave a false signal. We can argue about why, but I think it had something to do with long-term rates being lower than they should have been And really, for the last something like 18 months, the yield curve inverted last summer. Anyway, the yield curve led us astray and made us too pessimistic. I think we have a new business cycle on our hands in both Canada and the United States. And I think it's a different kind of business cycle. Okay. And by that, what I mean is, I think we're going to look forward to an era of higher interest rates than we're used to and higher inflation than we're used to. So that's my bottom line, Jason. That is the punchline. Keywords. I want to introduce a couple of keywords to everybody because quite often, that's what you remember when you listen into a webinar like this. What did he say? What were the key words? So here we go. I've got 10 of them. They're not just words. There's some of them are phrases. So the first one would be cruise altitude. Jason, you've been traveling. You know what cruise altitude is. It means you're not landing. And that's what I'm saying about the economy, Canada's and the United States economy. Cruise altitude, no landing at all. Word number 2 is limping. That's Canada. Canada is limping compared to the United States. And I would go so far as to suggest that Canada's manufacturing is borderline recession. Perhaps it even is a recession. And I'm looking at jobs in manufacturing, and I'm looking at manufacturing shipments and sales. Okay. Word number 3, target range. That's the inflation word, target range. You know something? We actually are pretty well there in Canada. We are basically into or about to be into the target range in Canada. Not so in the United States. The US is still not in the target range. So I think the Bank of Canada will move before the Fed. Now here's a number 4, more than one word, the Chips and Science Act of 2023 in the United States. What a difference it has made. What a difference it has made. And we'll get to that in our presentation. The Chips and Science Act. Okay, we're talking about technology, we're talking about productivity, and we're talking about the reversal of outsourcing. But that's for the United States, not for Canada. Jason, here's another one for you. Inclusion rate. Jason, I want you to talk about the inclusion rate in some detail. And you know what that means? We're talking capital gains, right? And I've got another word in my slide deck, reshoring, the opposite of offshoring. Reshoring. I don't know whether I spelled that right. We'll get to that in a moment. Here's a year, 2016. What do I mean by 2016? We have not seen output per person hour in Canada increase since 2016. We have a productivity crisis in Canada. Getting towards the end, Jason, in terms of my key words, but here's another one, logistics. Logistics. In other words, time is money. And the small and medium-sized business community is really into applying technology to the supply chain and to warehousing and delivery so they can ship faster. And what that is, it's technology, it's Google Cloud, and it's state-of-the-art. It's a state-of-the-art transition in terms of reinventing how things are done. Time is money. And by saying that, I'm going to say a little bit more about time. 18 months versus 10 years. What do I mean by that? In Houston, it takes 18 months to get a home approved or a housing development approved for development. 18 months, Houston. In the GTA, I've heard it can take 10 years. I'll throw in another little bit of number comment here. 145 days. Here's another number. 145 days to build a home in the GTA. What if we could change that to 110 days? Well, with a little bit of ingenuity, a little bit of applied technology, Google Cloud, and we can improve the logistics. So it's not 145 days to build a new home, it's 110 instead. And my final comment, the housing supply crisis, Jason. We're not going to solve it with rate cuts. Rate cuts are going to increase housing demand, but they're not going to help housing supply. Okay, Jason, I'm done with those key words. Back to you. What do you think? What are your comments?
I guess my initial comments are when you talk about productivity and credit and the state of the economy, our per capita GDP, why has Canada got it so wrong?
Jason, I'm a big believer in incentives. And I think that the government can be your partner or the government can be your adversary. And the Chips and Science Act is causing a revolution in US manufacturing. We have a number of sectors in the US manufacturing complex where you're looking at growth rates of 10, 12, and close to 20% on a 12-month basis in terms of what's going on. One of my slides, don't worry, we're not going there yet. One of my slides shows the explosion of investment, construction investment in US manufacturing. We're not getting that in Canada. So that's maybe a lead in if you want to talk about capital gains and what that might mean for incentives for business investment, business opportunity, and business success in Canada.
Well, I think, Peter, when you talk about the change in the capital gains inclusion rate, the day that our good friend you've talked to me about leaving Canada for the last 3 or 4 or 5 years. How can we actually do something about it? Because people are just fed up with paying tax, and it affects young people, it affects startup, and it affects stock option plans that are a big draw for younger people to take less employment income. And I was just in Edinburgh at a tax conference, and one of the things was looking at the capital gains rates in a significant number of other countries. And ours are higher than almost anywhere else in the world. We got a productivity problem. We don't have investment in capital. And our per capita GDP is, I think, sank the 16th or 17th in the world. And we're going to impose more tax on people. So I think Canada has a problem. And people, when you take 54% tax rate and you take capital gains rate by 17%. And I think every family in this country, and probably most people on this call, are affected by the capital gains inclusion, whether you have a stock portfolio, whether you have a cottage that's been in your family for generations, whether you have families that have a winter home, a summer home, and a principal residence. one now needs to go through the calculation in a much more detailed basis to determine where do you use your principal residence exemption. That is one of the things that Canadians have that doesn't exist as many places in the rest of the world.
So on that principal residence, what happens, Jason, if I own more than one property? Let's say I own 1, 2, 3 properties in addition to my principal residence. What's going to happen? And let's say I want to pass this on to my children.
I think there's tools that you can use, and the calculation generally is a quantitative one. That how long you've held it, what's the ACB, how much money do you have invested in it, are you likely to sell it? All of those factors have to be taken into account, but it really generally is a quantitative calculation. And one of the things that we have here from a capital gains perspective is we have a lot of clients who have second properties held through a family trust, where that gain in the value of that property that's been in the family for years will be able to skip a generation. So people still have time to go through this principal residence, second and third property calculation before June 24th and figure out what the cost is. And a lot of times, the tax that one would pay is really a time value of money calculation.
One thing I'll mention, Jason, is capital gains in the United States. Most people pay 15%. That's on long-term capital gains. You might pay 20% if you're in the 37% top marginal bracket. I'll mention again, 37% top marginal U.S. income tax bracket. U.S. capital gains, it's either 15% or 20% on long-term gains. On a short-term gain, chances are you could be, you could be paying, your full marginal rate, which at the top end is 37%. So interesting comparisons.
One thing you just indicated is that we're on this cruise altitude. There's no landing. We're not going to have a recession. We're in a new business cycle. One of the things that I'm seeing with some of our clients is that they've run reasonably successful businesses. They've made good incomes to support their family. And in 2023, 2024, there's been a significant increase in the cost to rent their facilities. There's been a significant increase in the cost of labor. And interest rates have gone up. And every one of those items they have no control over. And they can go from having a business that makes $400,000 or $500,000 to break even just because of an increase in rent. And so we are seeing people who have been in business for years are saying it's time to retire. I'm not going to work for the landlord. So I see those as two different outcomes. And how do you balance the two of those off?
One of the problems on rent, on shelter, Jason, is supply. It takes so long to get land approved. And so there is a shortage of land. It just takes so long for the approval process to work. And on the government side, they are looking at a huge backlog of approvals for construction, and they themselves are short-staffed. They don't have the physical headcount of people to help them out with it, and they don't have the financing to make that happen. But that gets us down a rabbit hole to some extent. Jason, why don't I get into my slide presentation and take a look at some of the things that feed off of the bullet points, the keywords that I mentioned. Thank you. Okay, we've got the first slide up here for people to look at. And I'm starting with the U.S. economy. I apologize for that, but it is the 800-pound gorilla. as far as Canada's economy is concerned. And in this title, Jason, you just mentioned it, the landing. I'm saying we're not going to see a landing in the United States. I think that we're on cruise control, we're at cruising altitude, at cruising speed. And if you look at this diagram, it's a bar chart. And what it shows is the growth quarter to quarter in the US, price adjusted volume growth, and we're looking at it in annualized rates. And on the right-hand side, you see it's an open bar, and that is for Q2, the quarter that we're currently in. It looks to us as if growth in that quarter is going to be up in the 3% range. This is a nowcast estimate. The word nowcast, let me just explain it. It's based upon the economic numbers that we have as of today. And you factor them into the formula that's used to calculate gross domestic product. It's not making guesses in terms of what's going to happen in June, July, August, and so on, but it's based on what we have as of this point in time today on the economic numbers and what it looks like the quarter will do. And this estimate that I'm showing you, it's not something I made up. It's made up by an authoritative research group at the Atlanta Federal Reserve Board. So if you want to check on this yourself, go on to the Atlanta Fed and go to their estimate of the nowcast for the US economy. Now, this changes every week or so, maybe even more frequently. And what it looks like is that the US economy is not in danger of stalling out. If you take that open bar, which is for Q2, average it out with what we had in Q1, which was 1.6, that's decent growth. We think that the economy is capable of growing by just under 2% a year in the United States, based on supply capability, based on the availability of workers and their productivity. So, growth like this is right in line with our supply potential. And I guess the other rule, the other secret of forecasting is that momentum has a way of feeding on itself. And so things are looking good. I wonder, for example, the consumer, I'll just make this one comment. There is no fear of losing your job in the United States. Job openings are running far higher than the number of unemployed people. And Jason, looking at the stock market, as of today, the S&P 500 index is up by 27% from this time a year ago. The Dow, not quite so much, but still 20%. 20% is a decent gain. That's the Dow. S&P 500 up 27%. So there's optimism out there, and that's feeding into business investment as well. So basically, I'd say this on slide 1. Do we really need rate cuts to help the economy in the US? Because, rate cuts would only stimulate things even more, Jason. So there you go. I would also summarize on this, good news for Canada, because if your major trading partner is in good shape, it's going to help you as well. Comments on that, Jason? What do you think?
Well, I think that when you look at the Canadian economy and you look at the American economy and you look at where Canada is slumping in the world, and you look at the size of our deficit, and our housing issues, it doesn't look
Peter, it looks like we lost Jason again. Do you want to move to the next slide?
Yeah, let me go to the next slide. And not to worry, technology, it's kind of like Murphy's Law, right? If it can go wrong, it will try to do it. So let me go to this. Yeah, reshoring. Now, everybody, here we go. I have a skill testing question for you on the line. Did I spell it right? Should it have an E in there? S-H-O-R-E? Or I don't know. I thought it would be more efficient to leave the E out, but this is serious. Take a look at this diagram. This is investment in U.S. manufacturing. It's capital spending in U.S. manufacturing for construction, okay? Construction. And take a look at that. We've gone from 80 billion up to 220 billion. So I'll tell you, if you are a supplier to some of these mega plants that are under construction, you are as busy as can be. You are having your best year ever if you are a supplier to US manufacturing construction. This really is a construction boom. Look at the change that we've seen from 2023 going into 2024. And what it is, everyone, it's the US government. It's the CHIPS and Science Act. So the US government has given major subsidies and tax credits and research grants. I think the number is something like $69 billion of stimulus. And so, you know, to me, the story here is we're looking at high tech manufacturing. We're looking at semiconductor plant construction. We're looking at communications equipment. This is keeping the U.S. economy modern. It's bringing back the supply chain to the United States, and it's making the
Recording
U.S.
in
economy,
progress.
it's making the U.S. economy even more productive. So this is giving the U.S. something that Canada doesn't have. Now, have you heard about reshoring back into Canada? Have you heard about mega plant construction for high-tech industries, semiconductors in Canada? No, I'm afraid we haven't. So the year 2016 is important because Canada's output per worker, in other words, productivity, hasn't improved at all since 2016. So there you go. That's the kind of, you know, the supply chain issues, the reversal of supply chains back into the United States. And finally, let's take a look at U.S. inflation. This is the next slide. So we'll go from reshoring to U.S. inflation. Thank you. Now, if you or I, speaking to people on the line, if we were running interest rates in the United States, this is what we would be looking at. This is the cutting edge of where inflation is going. And we're not using the consumer price index. We're using our favorite index, which is the personal consumption expenditure price index. And what that is, it's a shopping cart of things that you buy and you substitute. So the shopping cart is going to change every month because you're going to substitute away from expensive things to less expensive. So the shopping chart changes, and this price index measures a changing shopping cart. So it doesn't overstate inflation the way the CPI might. But this is what's going on. Take a look at the right-hand side of this diagram. The line shouldn't be going up. This shows you the change, not over just 1 month, but the change over 3 months. So it's the running change over the last 3 months at annualized rates. And lo and behold, it's 4.5%. Okay, now that's not good. That's not good. Let me show you kind of how you get that number. So we had an increase in March of 0.3, an increase in February of 0.3, an increase in January of 0.5. So basically, you kind of average those out. It's 1.00 1.3667. Okay, and take that to the power of 12, let's say, and you get 4.5%. So we think that's going to come down. We think we're going to start to see 0.2, 0.2, 0.2 on the month-to-month change. And if you annualize that, it comes out to around 2.4, 2.5% compounded. So we need to see that for a couple of months before the Fed is going to cut rates. Let's shift now to the next slide to show us, to show Canada. Okay, there we go. Thank you so much. You see at the very top, 0.13% was the move from March to April, the month-to-month move, 0.13%. Go down to the red line, kind of middle of the slide. What does that mean if you annualize it at compound rates? So there's the calculation, everybody. 1.0013 to the power of 12. That's a 1.6, 1.57 or 1.6% annualized rate of increase, April from the month before. And hey, guess what? That's in the target range. So Canada's looking pretty good. And if we do a 12-month change on consumer prices in Canada, we are coming in below 3% on the 12-month basis. So I would say to you that Governor Tiff Macklem at the Bank of Canada is getting ready to pull the trigger. You could do it perhaps in June. Now, I'm going to come to that later, but let's go to the next slide and take a look at the government sector in Canada. Now, what I've done here for you is I've got two slides. On the left, you see the private sector, and on the right, you see the government or the public sector. And I'm using employment here because employment is kind of our proxy for economic activity, economic output. And so take a look at the private sector. You can see from the middle of 2023, kind of flat. Take a look on the right, from the middle of 2023 up to now, bang, big increase. So Canada's economy is really relying a lot on the government sector to keep it going. Next slide. This is kind of interesting. This next slide, it shows commodity prices. And copper, copper is really a big player here. And copper going like this really says something positive is happening to the world economy, because copper is such a bellwether commodity, and it speaks a lot to what's going on in China as well. And of course, we're seeing this kind of movement in silver and gold too. So silver, gold, copper, giving this kind of recent news. And look how recent it is. It's only really just happened in the last month or two. This diagram is based on end of month prices, with the exception of the latest data point, because obviously it's not quite the end of the month. So this is what I had yesterday, $4.85. It's down a little bit this morning. I think it's $4.82. But nonetheless, what does it say? Maybe this is a bit of an inflation warning. Commodities have a lot to do with inflation. So the story is always changing, everyone. Nothing's ever 100% certain. But it ties in with my notion that this business cycle is going to be a business cycle where we do see higher inflation and therefore higher interest rates than what we were used to in the decade of the teens. Okay, let's take a look at the next slide, which is my kind of list of interest rate dates. Now, first of all, typically the Bank of Canada would follow what the Fed does. This time around, I think it's going to be different. I think that the Bank of Canada does not have to do or follow what the Fed does. Here are the dates for the Fed. The next interest rate date, June the 12th. Well, I think that's way too early for the Fed because that diagram I showed you on their 3-month running inflation rate, it's still way too high. I think they want to have at least 3 months of that running 3-month rate coming down to well within their target. Let's say down to 2.5%, something like that. They don't have to get right to 2% before they cut, but if they got down to around 2.5%, they would feel good about cuts. But we're not there yet. The latest number is 4.5 in that diagram. So going through the list of dates for the US, September the 18th is what the market expects. That is the market consensus. But a warning to everybody, consensus thinking can be dangerous. To me, September 18th, remember, it's election year. The election is on Tuesday, November 5th. I don't think the Fed wants to get engaged in a hot election campaign. So to me, they're going to skip until November the 7th. So I would write down November the 7th as the first time we see the Fed cut rates. And you know, they're not going to do it every month or every meeting, I mean. They're going to wait and do it every second meeting. So a cut on November 7th, but then they're going to wait until January. Now, I think it's possible we could see a cut on June the 5th. If we don't see one on June the 5th, I think we'll perhaps see one on July 24th. And then every 2 months. So that would be July 24th and then October 23rd. So 2 cuts for us, only 1 cut for the Americans, and we are leading the way. But what does that do for the Canadian dollar? If we cut before the Americans and we cut well before, we cut in June or July. Next slide, the Canadian dollar, everyone, I think it's going to go lower. So this is my last slide. And you can see the way the Canadian dollar has bounced around. But right now, it's trading kind of at the low end of what we've seen for some time. Right now, if you want to buy a US dollar, you have to pay 1.366 Canadian. So $1.37 Canadian to buy 1 US dollar. Now it's okay if you are earning US dollars in what you are selling into the United States, that 1 US dollar of earnings from exports is going to give you $1.36 Canadian. I think that we are going to see the Canadian dollar weaken further, and I think we're going to test the 72-cent level before you realize it. So pretty soon, I wouldn't be surprised if that 1 US dollar of export revenue is going to translate into close to $1.40 Canadian. So that's going to help the export sector, which of course is such a big player in terms of Canada's economy. So Tanya, I think I'm done here. I'm done with my slides.
Thank you so much, Peter. Jason, are you with us? I just saw him, so he should be back on.
So I think you're still with us. So what kind of questions, Tanya, do you see out there?
Hold on just a second, Peter. I'm just having a little technical issue here.
Hey, Tanya, is that better?
There we go. We can hear you now.
Yeah, perfect.
So, Peter, a couple of questions. And how is the U.S. market, the success in the U.S. market, and with Buy America and the CHIP program, how is that economy directly affecting the Canadian economy? What industries, what sectors? Is it very, very direct, or is it broad-based?
Well, I think a lot of it comes through the Canadian dollar, Jason, because you know, you have clients that have principal or major earnings coming from the United States, and those US dollar earnings keep getting to be more valuable in terms of Canadian dollars. Of course, you have clients on the other side too who have to buy a lot in the United States, and those US dollar purchases are getting more expensive in Canadian dollars. So that's one point. The other point, Jason, has to do with boardroom, cross-border boardroom psychology. So much in terms of boardroom psychology, I think, comes into Canada from their U.S. partners. And if there's this sense of optimism in the United States, which I think there is, and I only use the stock market example as just a rough and ready measure of what's going on, because after all, the stock market does reflect corporate expectations on earnings. That's really it. You know, you discount the future earnings that a company is going to have, and that's one formula for coming to the stock price. So there is this cross-border play with respect to psychology. And I think that psychology has been optimistic in the United States, and I think it's having kind of a healthy spillover into our boardroom thinking as well.
Yeah, a question from a solution perspective. The chip program in the U.S. has been quite successful at reshoring, creating jobs from construction perspective and manufacturing perspective. If for whatever reason, a government in Canada decided to follow the Americans and implemented Canadian Chip Program 2024, how long would it take for that to have an effect on the Canadian economy from a productivity perspective?
Well, I think one of the issues has to do with scale. In the United States, a program like the CHIPS and Science Act can really have an effect because of the scale of operations. These are mega plants. You know, Jason, if you've ever, for example, talk about a mega plant close to where I live, it's the Tesla plant. I have never seen a plant as big as this local Tesla plant. You know, talking about Fort Oakville, where I used to work years ago when I was going to college, this Tesla mega plant looks as if it's, gosh, 3, 4, or 5 times larger than Fort Oakville. But anyway, when it comes to scale, I think Canada's solution has to be through small and medium-sized businesses. To me, Canada is different, and I think that the small and medium-sized business community in Canada is really vital to Canada's competitiveness and Canada's role with respect to productivity, technology, and growth. And I think it's a real opportunity here for the SMB sector to apply the technology that's available to them, especially with logistics and supply chain management, because it really has to do with speed, the speed of production, the speed of delivery. And that applies to governments as well, because in housing, as I mentioned, 18 months in Houston to get approval to build, 10 years in the GTA to get approval to build. Time is money. So I think there's a real opportunity out there for Canadian businesses, the kind of clients, Jason, I know you're very involved with small and medium-sized businesses, to do it better and do it faster and incorporate, you know, incorporate what we have with respect to the technological opportunities that are out there. So, you know, Google, web technology, and all of its applications, yeah, it can be done, and it is being done.
The big announcements that our government makes with respect to these large battery plants, automotive deals that are funded with billions of dollars, do you believe that they have a positive or negative impact on the Canadian economy? And could the dollars be better spent elsewhere?
I think the problem, Jason, is that these plants are going to take 3 years to get constructed. So we live in the present, don't we? You know, three months to 6 months to 9 months. That's so much the critical time frame that realistically business has to deal with. And so when you're talking about a plant that gets approved and that's not going to be completed until 2028 or 2029, well, give your head a shake. How much difference is it going to make right away?
Another question, and over the last couple of years, our immigration policy has seen numbers like we've never seen before. What effect do you think such a large scale increase in immigration has had on the Canadian economy?
Well, right now, I think it's been more of a demand influence rather than a supply influence. My recommendation would be to have large scale training and language programs for immigrants. You know, it's difficult for immigrants to get the training they need if they don't speak the language that well. So I think that in the first instance, I would have an over the top big effort for English as a second language training, and to fund it with lots of money for teachers, and also give money to the students to encourage them to show up for these classes. Because how do you get the training? How do you get the skills training if you don't actually have capability in reading and in terms of the language?
Right.
I don't hear anything about that. Do you, Jason? Maybe I've missed it.
No, I haven't heard about it. And what you do here is a lot of this immigration is temporary, and that it's not permanent and has a negative effect on our housing problem.
Well, a million, you know, in terms of throwing out a word or a number, 1 million people in the last 12 months. 1 million people, not necessarily all permanent, but 1 million people nonetheless that need the basics. They need food, they need shelter, they need transportation. And where's the infrastructure for that? And in terms of infrastructure, in terms of the housing situation, we have a housing supply crisis, Jason. It's one to say infrastructure. It's a golden word to use. But if it's only repairing 70 and 80-year-old infrastructure in existing parts of the GTA, let's say, or existing parts that are well settled in Ontario and elsewhere, how about the infrastructure where they're building affordable homes that are outside of the city core? So what kind of infrastructure are we talking about? The infrastructure that provides water and sewer and electric power to the development areas, or fixing up decaying infrastructure in long established communities and subdivisions and neighborhoods? So
Okay, well, Peter, it's been wonderful. I'll ask if there are any more questions. You can put them in the chat. We have a couple of minutes left. If people want a recording, it will be on the website. And if you have any specific questions that you'd like to ask Peter, please send me or Tanya an email, and we will get back with Peter's thoughts on your questions.
Sure, I'll be pleased to do a 1 or 2 pager Q&A answer. That would be a good idea, Jason. Thank you.
Okay, if there are no more questions, here we go. Yeah, someone agreeing that the SME market is the greatest market in the world. It powers Canada. And how are we going to be able to cope without a stable tax environment and tax rates
that may continue to increase. I don't think anybody could have said it any better. It's difficult times for people who have been successful and through no fault of their own. So if people have concerns or need help, reach out to us. We're here to help. And thanks again. And we'll probably put this on in 6 or 8 weeks again. So thanks for joining. Thanks, Peter.
Thank you, Jason. Thanks, everybody. Bye for now.